What's happening in crypto right now, it's a huge paradox. On the one hand, you've got record-breaking institutional adoption. I mean, the smart money is finally, really here. But at the exact same time, the market is getting hit with this brutal, gut-wrenching crash. So what's going on? How can both of these things possibly be true at the same time?
And this really just shows you the two sides of the story perfectly. Over on the left, you have a giant like JP Morgan right at the start of the year talking about a pivotal shift, so much optimism. And on the right, you've got the reality for everyday investors, summed up perfectly by a Reddit user. The pain isn't just crypto, it's everything. And that's the great collision we're going to unpack. So let's start with the promise. The story that totally dominated the headlines earlier this year was that crypto was finally, growing up. It was putting on a suit and tie. That big institutional wave of money wasn't just on the horizon anymore. It had officially made landfall.
And the numbers? They're just staggering. In 2024 alone, a record-breaking $130 billion poured into crypto markets. That's a massive 30% jump from the year before. And that was the fuel for all that incredible optimism.
But the key thing here is the kind of money this is. This isn't just a few tech companies, adding some Bitcoin to their balance sheets like we saw before. No. We are talking about the very heart of the financial system. Hedge funds, massive asset managers, even pension funds. It's a fundamental change in who is buying into the space.
So why now, right? What gave them the green light? Well, all across the globe, regulatory clarity is finally starting to take shape. You've got the EU's big MiCA framework coming into full force, new laws being worked on in the US, the UK, Singapore. This is the bedrock, right? This is what gave those huge, normally super conservative institutions the confidence they finally needed to jump in. But just as crypto was finally getting its own house in order, the global economy decided to throw a party. And let's just say it wasn't the fun kind. A perfect macroeconomic storm started brewing, and it delivered a massive, massive reality check.
To put it as plainly as possible, the entire economic script just got flipped on its head. For months, the entire market was betting on interest rate cuts. And then, suddenly, that script was torn up and thrown out the window, catching pretty much everyone off guard, especially anyone invested in higher risk stuff, like crypto.
And this chart, it just shows you how dramatic that shift has been. For the first time in this whole economic cycle, the odds of an interest rate hike are now higher than the odds of a cut. If you'd said that a few months ago, people would have thought you were crazy. It signals a huge hawkish turn in how the market is feeling.
And it does not stop there. You see this number, $108.78? That's the price for a single barrel of Brent crude oil. Geopolitical tensions are shooting energy costs sky high, and that just adds another layer of intense pressure on the economy that everyone has to deal with.
Okay, so you've got this perfect storm brewing, but how does it actually hit the crypto world? Well, to see that, let's zoom in on one of the most fundamental parts of the whole industry, the Bitcoin miners. They are right on the front lines, and they are really, really feeling the squeeze.
Okay, before we go any further, there's a key term we've got to understand: hash price. Now, the easiest way to think about it is this. It's basically a Bitcoin miner's daily wage. It's the money they earn for all the computing power they're providing to the network. So when hash price is high, miners are happy. When it's low, they're in trouble.
And right now, they are in serious trouble. This combination of a lower Bitcoin price and at the same time soaring energy costs, it's been absolutely devastating. Miner profitability has completely collapsed. The hash price actually just hit an all-time daily low. So basically, their wages have never been lower, but their single biggest expense, electricity, is spiking. So what are they doing? Well, this pressure is forcing them to take some really drastic measures. A lot of them are selling their Bitcoin reserves just to keep the lights on. And get this, some are even pivoting their entire business, using all that computing power for the AI industry instead, just as a way to survive. But this whole market crash, it isn't just about financial pressure. It's triggering a full-blown identity crisis for crypto. See, for years, one of the most powerful stories has been that Bitcoin is digital gold, a safe haven asset. Well, that idea is being seriously put to the test right now.
And you can really feel the frustration out there. This quote from a Reddit user just perfectly captures the disillusionment so many are feeling. The promise was that crypto would be a hedge, a place to park your money when things got rough. But as this person puts it so bluntly, it's just not.
And the numbers, they totally back that feeling up. Just look at a recent downturn. The S&P 500, the stock market, it dropped about 2%. Bitcoin, it cratered by a staggering 20%. So instead of acting like a safe haven, it acted like a super high-risk tech stock, falling way, way harder than the market it was supposed to protect you from.
And hey, if the comparison to stocks wasn't bad enough, just look at how it's doing against its supposed twin, actual physical gold. While Bitcoin's been taking a nap, gold has surged over 55% so far this year. That's its best performance in more than a decade. The so-called digital gold has been completely outshined by the original.
Okay, so let's try and put these two colliding stories together. This huge institutional boom and this brutal macroeconomic bust to really understand crypto's new and way more complicated reality. What does it actually mean to finally get a seat at the main table?
Well, it seems like crypto's journey to the mainstream kind of followed these logical steps. First, the big institutional money arrived. That happened because the regulations finally started to solidify, which gave them the confidence. But that integration with the big global markets, it came with a catch: exposure to global shocks.
And that brings us to the single most important takeaway here. Crypto is no longer an insulated asset class. For years, it kind of existed on its own little island. But getting that institutional buy-in, getting that regulatory clarity, getting that seat at the grown-ups table, it all came with a price. And the price of admission is that now, when the global economy gets shaken, crypto gets shaken right along with it.
And all of this really leaves us with one big, fascinating question for the future. As crypto gets more and more tangled up with the traditional financial system, will it lose the very things that made it so unique in the first place? Is it destined to become just a high-stakes, high-volatility mirror of the global economy? That right there is the new reality, and the great debate that lies ahead.